Hey everyone, welcome back to our channel. Today, we have an important topic to discuss, the collapse of First Republic Bank. It's a story that has shaken the banking industry, and we're here to break it down for you. So, let's dive right in. Before we get into the details of the collapse, let's take a quick look at the history of First Republic Bank. It was founded back in 1985 by James H. Herbert II, with a focus on jumbo mortgages, CDs, and savings accounts. Initially operating in San Francisco, the bank specialized in lending for luxury homes and investment properties. Over the years, First Republic expanded its services and markets, becoming a full-service bank. They built a reputation for offering personalized service to high-net-worth clients. In 2007, the bank merged with Merrill Lynch, which was later acquired by Bank of America in 2008. However, in 2010, Herbert raised private equity capital and bought back First Republic. Now, let's get to the heart of the matter. What exactly happened to First Republic Bank? Well, it was taken over by the Federal Deposit Insurance Corporation, or FDIC, at a cost of around $13 billion. The bank faced a flight of deposits in the first quarter of 2023, leading to a severe liquidity crunch. In a move to address the situation, JPMorgan stepped in and purchased First Republic Bank. JPMorgan announced that it would acquire $92 billion of First Republic's deposits. This acquisition by JPMorgan was a significant development in the banking industry. So, why did First Republic Bank fail? Let's take a closer look at the factors that led to its collapse. Uninsured deposits. One major contributing factor was the high number of uninsured deposits at First Republic Bank. Uninsured deposits can trigger a bank run when investors panic. Shockingly, more than 67% of the bank's deposits were uninsured as of December 2022. Mainly from their wealthy customer base. Lack of liquidity. First Republic Bank relied heavily on net interest income from loans and investment securities. However, many of their investments were in real estate loans and municipal securities, which were less liquid and not earning competitive interest rates. In fact, among mid-size banks, First Republic had the highest ratio of loans and securities to uninsured deposits. In December 2022, credit ratings downgrades. First Republic faced repeated downgrades from credit agencies. These downgrades were due to concerns that the bank's liquidity, funding, and profitability challenges wouldn't be resolved by financial infusions. Mistrust in regional banks. The collapses of Silicon Valley Bank and Signature Bank earlier in the year had already created fear and mistrust among investors. Coupled with the credit ratings downgrades, this increased the concerns about keeping uninsured deposits with a regional bank like First Republic. Now, let's talk about the broader implications of First Republic's failure. The combined collapse of Silicon Valley Bank, Signature Bank, and now First Republic has raised significant concerns about the banking system as a whole. The Dow Jones U.S. Bank Index has fallen about 16% since Silicon Valley Bank's collapse, reflecting the uncertainty surrounding these events. While other banks remain vulnerable, it's essential to note that there are still approximately $1 trillion in uninsured deposits held by U.S. banks. Additionally, banks heavily exposed to bonds and mortgages may continue to face strain due to higher interest rates. That wraps up our discussion on why First Republic Bank collapsed. So, what does the collapse of First Republic Bank mean for other banks? Well, it serves as a stark reminder of the challenges facing the banking system and highlights the vulnerabilities that exist. The banking industry is interconnected, and the collapse of one institution can have a ripple effect on others. The recent collapses of Silicon Valley Bank, Signature Bank, and now First Republic have created uncertainty and raised concerns among investors. As a result of these events, the Dow Jones U.S. Bank Index has experienced a significant decline, reflecting the market's unease. This decline shows that the failures of these regional banks have wider implications and can impact the overall stability of the banking sector. It's important to recognize that there are still around $1 trillion in uninsured deposits held by U.S. banks. This means that there is still a considerable amount of risk in the system. Banks need to address their liquidity and funding challenges to instill confidence in depositors and investors. Furthermore, With the possibility of higher interest rates, banks heavily exposed to bonds and mortgages may face additional strain. The changing interest rate environment can impact their profitability and ability to manage their assets effectively. In conclusion, the collapse of First Republic Bank serves as a reminder of the risks inherent in the banking industry. It highlights the importance of robust risk management, liquidity planning, and maintaining the trust of depositors and investors. The repercussions of such collapses extend beyond the affected institutions, impacting the broader banking system. Thank you for joining us. If you enjoyed this video, don't forget to like, share, and subscribe for more fascinating content.